Welcome to Chart of the Day. I'm Robert Folsom. RIP Bull Market, what the throwover has overthrown. Here's a chart of the Dow Jones Industrials over the past 6 months. This chart of the day will show you just how much of this price action you would have been ready for if you'd been reading our flagship Elliott Wave Theorist and our other publications. In fact, from this time, the theorist spelled out a forecast for what should happen with a level of detail you'd expect only after the price action had happened already. If we scroll prices back to November 28th, you'll see what I mean. So, on November 28th, the theorist published an interim bulletin to show subscribers this chart of the Dow and this longer-term Dow chart, which shows the long-term bull market since early 2009. Interim bulletins publish at crucial junctures in the market, and what was crucial here was these channel lines, which is why we zoomed in on the chart and showed that the Dow's price had broken the upper channel line. The theorist said, when the Dow exceeds an upper trend line and then falls back below it, it completes what R.N. Elliott called a throwover, indicating exhaustion of the larger trend. We also said the throwover pattern can last a day, a week, even a month, so let's jump to December 19th. The Dow's price did indeed throw over. This is the chart and headline we showed theorist subscribers on December 19th. Because the throwover is a reversal pattern, and to drive home how powerful a reversal it can be, the December 19th issue also showed this chart from 1929. So, once prices had clearly exceeded the upper line, the question then was, would the Dow fall back below it? The market continued to rise in January. On January 24th, we published an interim bulletin to say how several indicators stood at or near all-time extremes. On January 26th, 2 days later, the major stock indexes hit a record high. On Monday, January 29th, the indexes turned and the precipitous decline began. The throwover was completed by February 5th. Prices bounced into February 21st, when our interim bulletin said, I am publishing this now because many observers say that the stock market is heading to a new all-time high. Not all markets crash immediately after a throwover. Sometimes they take their time falling. The counter-trend bounce continued till February 27th, when we published another interim with this observation and forecast. After topping on January 26th, the Dow fell for 2 weeks into February 9th to finish Wave 1 and has since rallied for 2 weeks into this morning for Wave 2. The subsequent reversal appears to indicate exhaustion of the rally. If the rally resumes and the NYSE Composite Index exceeds this morning's high, today's analysis will be negated. Please note how well this analysis defines the risk. A marginal rise would negate the forecast, otherwise the move is exhausted. And that day did mark the high of the counter-trend move, and it moved decisively lower from there. The final interim bulletin we present is from March 13th, when we said that the Dow appears to have marked an important peak. The market is poised to accelerate downward, and you know what has followed. So we'll conclude with a March 23rd comment made to subscribers in our short-term update. It may be scary to some, but we understand the market's bearish potential. Stock market actions following the completion of a throwover can be violent, particularly in a high-degree bear market. Please see below for subscription information.